Good morning, everybody, and welcome to the Siler Wealth Management video blog, St. Patrick's Day edition, Thursday, March 17th. And if it wasn't for my daughter, I didn't know today was St. Patrick's Day. I just found this out yesterday. But thanks for joining me, and a lot going on as usual. Markets are active. You have some wide swings still, however. The wide swings are a lot different than they were back in January, February. You have wide swings before. They've opened up a little higher and then absolutely get pelted by the end of the day. We're seeing the opposite. We're seeing markets open up plus or minus, up or down a little bit, but then close with a little bit of strength. And yesterday concluded a two-day Federal Reserve meeting, and Janet Yellen basically said, and she was a lot more dovish than she was hawkish, excuse me, because the allergies are kicking my butt. But what that means is, at first, when they did the first rate hike and bumped rates to 25 basis points in December of last year, we were expecting about 4 rate hikes this year. They came out and said, hey, you know what, expect 2 rate hikes this year. So that's a little bit more favorable for the economy and for the stock market. They still think the economy is growing okay. Look, there's certainly international concerns overseas and with China, Russia, Japan, and they have negative interest rates. That's a concern. However, they do continue to say we are moving forward despite the headwinds overseas. So what does that mean? Well, by the year end, the Fed funds rate, which now sits at 25 basis points, plus or minus a few, we see that going to 75 basis points. So that means by the end of the year, your credit cards, loans, etc., will be, especially anything that's fluctuates, will be up 50 basis points or 0.5 or 1%. Now, the target for the Fed is to be at Fed funds rate. Remember, we're at 25 basis points right now. Fed funds rate at 3.25 to 3.5%. That's long term. That's we're looking at 2019. That's their target. That is more normal. That is what the normal Fed funds rate is. We've been in very unnormal circumstances because of the recessions and the financial crisis and so forth. So, okay, now what does that mean? Well, I've said this very many times that you folks are spoiled because you have 3.5% mortgage rates, 4% mortgage rates. All of a sudden, mortgage rates tip up to 4.25. Oh, that's too high. But guess what, folks? We're going back to the normal mortgage rates. By 2019, your home mortgages are going to be 6 and 7%. That's the fact. Okay, maybe the standards will be a little bit looser. Maybe it'll be easier to get a mortgage by then. But fact of the matter is, you will see 6% mortgages in a couple of years. That's going to happen. Now, the Fed was, they were constructive. And again, on the economy, said, look, things are going okay. We're growing a mild. They're a little concerned about inflation, excluding food and energy. But hey, who uses food and energy? Nobody does. I think that's the dumbest thing they can do is that our inflation rate, excluding food and energy, like nobody uses it. Now, oil has been firming up, so we're going to start seeing gas prices move up a little bit. Now, the bottom line is, when you see that rates are going higher, you have to start adjusting your portfolios, and you have to start looking at assets that are non-correlated to the stock market, assets that don't care what the stock market does. That's what we do. We take our portfolios and say, okay, let's take a piece of the portfolio and say, we don't care if the market drops down 1,000 points. It's not going to affect this investment. Those are things you have to look at. And I mentioned something about some apartment investments. I got to tell you, the apartment industry is huge. 96% occupancy and rates going up. And now with interest rates going up and mortgages, a lot more people are going to have to rent apartments than buy homes. That's just the fact of life, folks. Okay, so this morning I'm watching CNBC at 6 a.m. and I saw a poll. Very interesting poll. And of course, we have this political lunacy going on right now, and the Republicans self-destructing. The Democrats have nobody running that's worth a darn either. And quite frankly, whether you're Republican or Democrat, there really aren't great choices. I think we can all agree there. Okay, so that being said, there was a poll taken for CEOs in this country that went to Yale. So the Yale CEOs have taken a poll. And who would the Yale CEOs vote for president? Well, the numbers were interesting. It was about 40% of the Yale CEOs said they would vote for Hillary Clinton in a general election. 36% voted for John Kasich. Very interesting because, in my opinion, John Kasich is probably the most qualified to run the country out of all of them. However, he's very low in the Republican primary polls. I mean, he's the last place right now. But Trump and Cruz were way down. They were in single digits based on the Yale CEOs. Now, this is the same Yale CEOs were asked who they thought would be better for the stock market and the economy. And I'm going to lump those two together. There were two separate polls, but they were really close as far as numbers. So I'm going to give you round numbers, and I'm going to just lump them together. So which president or potential candidate would be best for the stock market and for the economy? Overwhelming 60%, okay, plus or minus a couple. One was 61, one was 62. Let's call it 60%. Said John Kasich would be better for the economy and the stock market. The next closest person, Hillary Clinton, 20%. That's pretty interesting. And these are guys that I would consider to be fairly smart. And again, this was a Yale poll. You could probably find it somewhere on CNBC, somewhere on their website. That being said, thank you very much to the folks that attended the Women in Investing workshop we had a couple of days ago. It was awesome. And I assure you, these women left with a lot more knowledge, and knowledge is power in the stock market. Knowledge is power, and I'm telling you, they left with some good knowledge. So, however, I was not prepared for today as far as the cruises. I promise I will give 2 away on Tuesday, and I just forgot. Okay, I didn't have it prepared. I didn't add the new people that liked it, because if you like my video and you share my video, you get 2 entries for Cruise for 2 for free. All you have to pay is port charges to the Bahamas out of Palm Beach. So if you share my video, you get 2 entries. If you like my video or like the Silent Wealth Management Facebook, you get 1 entry. I just didn't add the new ones in there. I'm sorry, my bad. I will do it over the weekend and have them ready for Tuesday. So you have chances to share my videos, share my crazy, like them, and you will get those entries and win a Cruise for 2, okay? With a potential. Thanks for joining me today. I want to keep it short and sweet as usual. I'll have another Women in Investing. I'll have another Investing 101 workshop. We'll talk about that after the Easter holidays. Everybody have a fantastic weekend. The market is indicating a little bit lower opening today. Struggles over at Caterpillar is affecting the Dow today. Caterpillar down in pre-market, and it's affecting the Dow about 20 points to the Dow. The Dow's indicating about 50 points lower. That's going to fluctuate. Not a big deal. We've had a pretty good move. Oil is up today and firming up, not helping the Dow. However, hey, I'm Lee Seiler. If we can help you with your 401k rollovers, we met somebody again yesterday that, oh, by the way, I do have an old 401k at a company I worked at 10 years ago. Folks, that's crazy. That's the first thing you got to do in your financial planning. Consolidate those 401ks, move them to IRAs where you can self-direct them. The fees will be cheaper, and you have professional management. Call us at our office if we can help you out. I'm Lee Seiler, President, CEO, StockDoctor.com. Silent Wealth Management. You guys have a fantastic day and weekend.